Hi, I'm Joe Macek, Portfolio Manager and Financial Advisor with IA Private Wealth. And in this video, we will go through the last half of 2021 and what a year it's been. Let's jump in. Happy holidays, everyone, and wow, what a 2021 it has been. Thank you so much once again for tuning into my market commentary for the last half of 2021. And we have a lot to go through as there has been some significant developments from the Federal Reserve, the illness, red day buying, and I will be sharing updates on my key indicators, one of which is disappearing. As always, before we get too deep into the video, I'd like to go through my usual disclaimer. And the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional or feel free to reach out to me on a one-on-one basis. The other thing you need to do is smash that like button for the YouTube algorithm, as it really helps out my channel. And if you happen to like my content and want to be kept in the loop with all of my latest videos, I would be thrilled if you would just hit that subscribe button and darken that notification bell. Also, do you have predictions for 2022? Do you have some feedback for me as to what topics you would like me to cover? If so, please leave your thoughts in the comments section below. I love hearing from you and I make a point to comment back. In today's video, I will be covering three key developments in the markets that I believe are significant and my thoughts as to how 2022 could shape up. However, my calls for 2021 were largely correct, as I had a higher than usual equity weighting in our portfolios that served us very well, and they were consistent with my original thoughts that the market would be higher with spurts or bouts of volatility that would eventually lend themselves to entry points or buying opportunities. These prove correct for 2021, and hopefully I can be as accurate for 2022 as I was for 2021. With that said, the three key developments I want to talk about are the Federal Reserve, the new Omicron variant, and the relentless onslaught of buying on red days and dips that happened in 2021. But first, just how large a change did the Federal Reserve make in its thinking surrounding the handling of interest rates and the tapering of the balance sheet? If you have been watching my videos at all, you would be well aware of how critical I've been of the Fed in the past on handling the last tightening phase, as I believe that when the Fed elected to roll off the balance sheet at the same time as hiking rates a few years ago, they tightened too quickly and were chiefly responsible for inverting the yield curve, leading to a sudden market collapse in 2020. Well, it seems that Mr. Powell could be learning from what I think are his past mistakes, as now he has made it abundantly clear that he will not raise rates until tapering is complete. He won't be doing both at the same time like he did before.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets. So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen.
This is a massive change at the highest levels of the Federal Reserve, and one I have looked for. To have Jay Powell say that they have learned from the past that in manipulating the balance sheet and tapering has an effect on markets is pretty much the exact opposite of what they said and did in 2018-2019. This leads me to believe that with the taper ending in the first quarter, the chart on the Fed assets will look something like this. Once this is done, the Fed will not rush rush to raise rates, but will carefully and diligently watch the markets and the economy to see how they respond to the reduction in liquidity. If the markets can handle it, I would suspect that the Fed could hike in the summer or late fall by another 25 basis points, further reducing liquidity. But it's clear the Fed will be tightening gradually. I would view this development as a very large positive for stocks in 2022. One further point on tightening I would like to make: the last time rates were cut to zero in 2009, the first rate hike wasn't seen until December of 2015, and the markets were able to continue to do well for another 5 years until the 40% collapse in 2020. Other cycles in the past are quite similar, and I would suggest even if the Fed does decide to hike rates this year, we have at least 12 to 18 months of reasonable market returns until risks present themselves. Our next point is on the Omicron variant and the illness, as late in the year this new variant shook markets and confidence as it was the most contagious of any variant yet to spread, with cases doubling every 2 to 3 days. Fortunately, the markets believed that Omicron was not going to be an issue, as they soon started to rebound, along with initial reports that suggested Omicron, though extremely contagious, was not leading to higher hospitalization rates or deaths, as the symptoms in many cases were very mild. Now, there are some health experts even speculating that Omicron could be the variant that leads to the beginning of the end of the pandemic, as the world will develop antibodies either from vaccination or from infection, protecting us from future variants. Now, I am not an epidemiologist, nor am I an expert in pandemics, but when I look back in history to find out how long previous pandemics lasted, I found on average most pandemics lasted about 24 months, give or take, with the longest and deadliest pandemic in history being the bubonic plague that lasted about 5 years and killed approximately 2/3 of the population of Europe. We are now in and around the 24-month mark of this pandemic, and I would think, or at least hope, we are closer to the end of this pandemic than the beginning. And if we are close to the end, and if this illness does leave us this year, or at least we learn to live with it, I think this could be another positive catalyst for asset prices this year, as we would return to a new normal. Third, we have to look at the relentless retail buying of dips in 2021, which was nothing short of astounding. Of the dozen or so dips that the S&P 500 had this year, they were all met with a retail wave of purchases, supporting asset prices with a vengeance. This Bloomberg article states that retail investors are betting that Wall Street's unease over the Omicron variant and the Federal Reserve's signal of stepped-up efforts to combat inflation are misplaced, and that brought net purchases over the past week to $7.36 billion. Retail traders preferred to snap up index tracking ETFs as well as large cap technology companies. The power of these retail investors cannot and should not be overlooked, and I suspect the same buy the dip mentality will continue into 2022, as we have an entirely new generation of savers that are relentlessly buying this market and the stocks within, regardless of valuation. With new apps such as Robinhood, M1 Finance, and Wealthsimple Trade, an entire generation now has access to investing in the markets and are learning how to invest earlier and are saving more money. A recent survey conducted by the Bank of America found that 73% of millennials are actively saving money, and more than half, almost 60%, have $15,000 or more in savings. Perhaps even more impressive, the survey found that nearly 1 in 4 millennials, almost 25%, has $100,000 or more in savings. Millennials could be the generation that has the title of best savers, as not only are millennial parents saving twice as much as the boomers did, they are on average starting 11 years earlier, and they are putting more than 10% of their income towards retirement. This is a large wave of money that will likely continue to find its way into the markets in 2022 and beyond. And this money so far has not shown any concern in the least with valuation. It is conceivable that this trend continues, and I view this as another positive driver of asset levels in 2022. Finally, we look at my main indicators to end the year, and we see that the yield curve is still normal and fairly steep. LIBOR is near zero, and oil and gas is still reasonable. As I mentioned earlier in my introduction, one of my favorite indicators, LIBOR, is being discontinued. LIBOR, or the London Interbank Offer Rate, is no longer going to be done after 2021. So now I have to find a substitute, and so far it looks like SOFR will be the one, but as I look at SOFR charts, I'm not convinced this chart will be too useful in the future. It was nice to see what the banks charged each other for money, as it gave me yet another sense as to how much liquidity there was in the banking system. Now that that's gone, I will have to find yet another indicator, and hopefully it will be just as good as LIBOR. Oil and gas prices could be a drag into 2022. As we all know, energy costs affect us all, and a high oil price that leads to high prices at the pumps could lead to less consumption for the United States next year. And as we all know, upwards of 70% of US GDP is consumption, and we need healthy consumption to have a healthy economy. There are many analysts that believe that oil prices will continue to march higher into 2022. I also believe that there is a good probability that oil reaches higher levels next year. There are two key reasons for my thoughts on this. First, with oil being so low for so long, there has not been a lot of investment into North American exploration or development. Today, capital expenditures for oil companies are at an all-time low and have been for several years. Second, borrowing and investment costs have gone up considerably if you're an oil and gas company, as many financial institutions have completely steered away from these types of loans. The climate change movement has affected money flow into this sector, as more and more corporations are shying away in favor of a more green appearance. The reality is we are not using any less oil. In fact, our oil consumption today, without the full capacity of the airlines, is virtually back to where it was pre-pandemic. With demand continuing to be strong and supply weak going forward, it stands to reason that oil will likely head towards 85, 90, maybe even higher in 2022, unless of course OPEC changes its stance on its supply. Now, I know I've been saying this for the last few videos, but I will be doing videos on my indicators and explaining why I put so much faith in them. But in the meantime, I believe that 2022 will be another positive year for the markets. While liquidity is slowly being removed from the markets, I think it will take longer than 12 months for that to take effect, and we continue to favor equities over all other asset classes for the foreseeable future. I would also look to add to my position on red days or dips, as I have in 2021, to further growth going into 2022. So once again, I want to thank you for joining me today here at Investing Made Simple. Please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and want to be kept in the loop with all of my latest videos, I'd be thrilled if you would just hit that subscribe button and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.